Hello guys, for some reason my camera is slow to be loading, so perhaps we might need to take the camera off. Yeah, that seems weird, my camera's not loading, in which case you can hear my voice, you can't see my face, but that's my face right there. That's me, Becky Hayman. My email address is becky@traddictiv.com, and my another email address that you can get to us is support@traddictiv.com. Again, apologies that the camera's not working, but hopefully, of course, the most important bit is that you see the screen. So as long as you can see that, we're good. So let me just make sure that the disclaimers are covered. So they will be in the top left hand corner. That's the disclaimers there. So by all means read that, because we want to make sure, of course, that you understand what these kind of videos are, not just for legal purposes, but also just to know what you can expect from these kind of things. They are demonstrations and do not necessarily what would it be? Do not necessarily dictate or indicate the results that you may receive on using the products and things like that. Okay, so let me just explain quickly what we do here. So we're going to look through the current market environment in stocks. Of course, we are on solid as a stock. So we're going to look at the current market environment. We'll look at a trade review. So closed trades that we've already taken that might have closed either for a profit or a loss, or perhaps trades that we might have cancelled. Trade management, so open positions, any trades that might still be open and how we might deal with that and what we might do about it. And trade execution as well, new opportunities if we can find them. Now, all of these videos that we do, we're looking at real life market situations. Sometimes you do things and there isn't anything to do. There isn't any new opportunity. So we'll do our best to find it. Sometimes we find loads and we place loads of trades back to back. But of course we will see, and we will obviously do our best to find a great opportunity. Now, one thing to just make sure that you guys are aware of is that we are streaming to different places. So we are streaming out to Facebook and YouTube and LinkedIn and Twitch, and within our closed coaching community as well. We are streaming to different places, which is great because it means different people can access us in different ways, and most of those places are free. So what's the difference then? If some people are paying to access this and some people are getting it for free, well then that doesn't really seem fair, does it? So what we do is after about halfway through, which when we're looking at markets where we're going to be trading in, such as Forex or stocks or whatever, basically anything but our sharpening sessions, normally it's after we find at least one trade, we'll cut the stream to the free sessions and we carry on in the closed coaching community. That's where people are paying a small monthly fee to be able to have access to that closed environment where they get access to more of our time. So they essentially get twice as much time with us because they get the free side and then they get the closed bit as well. So after about halfway through, after we find an opportunity, that means everybody that's with us, wherever you're watching, will at least see one trade that we put on and understand how we do things, and then we carry on in the closed coaching. Okay, so I just wanted to give you that background so you know what you're looking at, know what you're watching and know what's coming. Now this is a link here, tradewithufos.com/Becky. From here you can get a free Trade with UFOs membership and you'll get recordings of the session. You'll get not just of this session but every session that we do, reminders of different sessions as well. You can also book one-on-one coaching from here if you'd like, and there's also an area where you can ask questions in a public space, and we can also answer them in a public space. So you can see down here questions that people have put before and the answers that are relative to that. So again, hopefully that all makes sense. Again, any questions, just let me know. By the way, I am checking different chat boxes, seeing where you guys are and what questions you have. So by all means, if you have questions, please do post them in the chat boxes. I'll be happy to answer them live. If not, of course, you can send me questions after the fact by either using this link or going to so the link here, tradewithufos.com/Becky, or using my email address. Okay, so first things first, let's look at what we had before. We placed 4 trades last time. We placed 1 in the sort of live session, and then we placed 3 more in the closed coaching. So I'm just going to go through them. I think we did HBAN, Huntington Bank Shares Incorporated. That was the one that we placed in the live one. So in this one, what happened? Well, it triggered on the 14th of September. It was placed on the 10th. when we had a confirmed upwards climate. And for those of you that might be new, essentially we had a thick blue dot there on this app that we use. It's a free app, Auto Climate app, that told us probability was upwards, and therefore we looked to buy. So we placed the trade on the 10th of September we placed the trade on the 10th, which is here, using a thick blue dot. So it's just this dot here, thick blue dot, probability up, placed on the 10th of September. Now it triggered on the 14th of September as the market opened. Now, what happened to the trade depends on how strictly you look in on your trades, how strictly you manage them, what your rules are, and how often you were looking. If you looked at it any time on the 14th of September, then you would have realised, so if I highlight on the 14th of September, either one of these times, on the 14th of September, the dot was thin, meaning we lost probability to the upside. So as the market opened, you could have, well, as the market opened here on that day, you probably would have, if you checked the markets, you would have cancelled this trade anyway, because you lacked probability to the upside anymore, which means you never got into this trade, which means although this came down and went through and would have stopped us out, actually would have gapped down and stopped us out a little bit lower than what we wanted. If you were in this trade, you got out here and you lost. If you were checking in on it, you would have cancelled the trade and never got into it anyway, which means this was neither a loss nor a profit. It was a nothing to you. You cancelled the trade. If you didn't check in on it and you just left it, then you would have lost this trade. So depending on how hot you are on management and on checking in on your trades, depends on whether or not this would have been a loss or a nothing trade, something that you wouldn't have done or been in. So that was HBAN, which is the ticker symbol we use for that, HBAN. Then in the closed coaching, we put on MGM. So with this one, again, placed on the 10th of September when we had a thick blue dot. So we had probability upwards on that day. Triggered on the 14th of September, again, on a day where we lacked probability. It went thin, meaning we no longer had probability to the upside, meaning if you'd have been checking in on it, if you'd have been managing your trades, you would have seen that we wouldn't have had probability and you would have cancelled the trade. Again, meaning that you wouldn't have suffered this loss. If you didn't check in on it, then you lost this trade. So we've got two different trades here that the hotter you were on management, you wouldn't have even got into the trade, you wouldn't have lost. If you weren't hot on management and you just put this in and left it like a set and forget kind of thing, without checking in and checking what the climate was telling you, then you would have had a situation where you'd have taken 2 losses so far. So again, depending on your management style, depends on what actually happened to you here. Then we had Kellogg's. So Kellogg's we placed on the 10th of September. And we placed it on the 10th of September because we had probability downwards. This was a short opportunity. So placed on the 10th of September to the downside. Now it triggered again on the 15th of September, so that same week, and that's where the dot went thin. When the dot is thin, that tells us not enough probability. It doesn't matter the colour. So again, you wouldn't have actually got into this trade if you'd have been managing it. If you hadn't have been managing it, then you would have got into the trade and you would have got out at your safety target already, and still be in the trade at the moment, providing that obviously now we've got a thin dot there. You would get out if you were looking at it now. You would get out, and overall you'd get out at a slight profit. So again, depending on whether or not you managed it strictly every day or whether or not you just left it, would depend on so far whether or not you took 2 losses and then a small profit, or whether or not you weren't in any of these trades at all. Now the last one we put on was Google. So let's take a look here at Google. Google's obviously an expensive stock, so you can't really buy many shares with Google. But let's check this out. So with Google, we placed it on the 10th of September. When we had a thick blue dot, we had probability upwards. And it triggered here on the 20th of September. Now, you may have cancelled this trade. Not because as we can see, we've got a blue dot still, thick blue dot, which means the trade is still valid for that reason. But if we just spread this right out, but what we can see is that the EMA this week, starting on the 20th, the EMA is no longer lining up. It's no longer between our entry and stop. So again, you may have cancelled this trade because you no longer had the EMA lining up, which is one of the things that we have to have in our methodology to be getting involved with. Or you would have left it, got into the trade, hit your safety target, and actually be on the way to the final target. So what we had here, and I'm just going to move price to the side here just so I can make a point on this. So we had 4 trades. We had 2 losses and potentially 2 break even or profits, depending on whether or not you're just going to leave these trades open, whether or not you close them now, or whether or not they come back and stop you out. So minimum break even or profits. So let's say you left it. This is assuming you left it. So we have 4 trades. Assuming you left it, this would be your situation. 2 losses, 2 break evens, or 2 profits. So overall, you might be slightly up or you might be slightly down. You could have, and this is, I'm just going to put here, set and forget. Or you did 4 trades, and I'm going to just put the box over it again, and you had all 4 of them cancelled before entry. Which means you didn't have any losses, you didn't have any break-evens, you didn't have any profits. Those are the extremes of, are you just leaving it or are you managing it? And which is better? If we just take these first 2 losses, then you could say, oh, should manage it better, right? Because I want to avoid these losses. If you just had profits, then you might argue that managing it would have stopped you taking a profit. What we see here is that managing it can sometimes prevent you from losing. It can sometimes prevent you from taking profits. But if you managed it properly and you cancelled all of them before entry, you didn't take any losses. You didn't have any capital at risk. And to me, I think it's better to make sure that you have no capital at risk when you don't have probabilities anymore than leaving it and hoping for the best. So ideally, this one, I'm going to put a bigger box around this. Ideally, this is what happened to you. You had 4 trades that were all cancelled. Whether or not they would have eventually gone to stop you out or profit or give you a profit is irrelevant. You didn't have anything lining up anymore, so you didn't take the trade. Ideally, that's what happened. Worst that happened to you is you're somewhere in here. You've taken 2 losses. You've got 2 trades that are already at a break even and perhaps profitable for you. That's the worst that would happen to you if you just left it. Okay, so hopefully that all makes sense. What we'll do now is we'll look for new opportunities. So what I'm going to do first, I'm going to come to the economic calendar on FX Street. And by the way, guys, just a reminder, if you do have questions, by all means, please let me know. Let me know if you have questions. Let me know if things don't make sense or if you have any suggestions of stocks to look at or anything like that. Just let me know. What I'm doing here is I'm going to the United States and high impact news. So news that is going to have a high impact or likely to have a high impact on the United States markets. And then what I'm going to do here is I'm going to choose, the time frame is going to be from this week to, let's do October the 1st, which is next week. So 1 full week. So that way we can have a look at it and we can say, okay, we've already had some news come out today. On Monday morning, Eastern time, we have some news coming out that may affect US markets. Same on Thursday and same on Friday, just a little bit later in the day. So if you're trading over the sort of short-term swing trading, you might want to be aware of that. It's kind of similar to getting out of trades before earnings come out. It's when we see big impact, is when we see more likely to see volatility. That's then a problem. If we have volatility and we're on small time frames, we're more likely to perhaps be stopped out when we shouldn't be. And so therefore a lot of traders, if they're being more conservative, will close their positions before that. So be aware of these things, depending on the time frames you use. So what I'm going to do, I'm going to use Top, which is our sort of proprietary platform that we use, and I'm going to use this to scan for new opportunities. Now let's just have a look. I've already got the ES open at the moment, and if we just squidge this out and do it that way, got the ES open at the moment, and the ES is the futures contract that represents the S&P 500, which is the top 500 US stocks. Essentially, what we have right here is a representation of US stocks. That's what we're looking at. And for the market as a whole, we actually have probability to the downside on a weekly chart. Probability to the downside is obviously telling us that we should be looking to sell. Now let's go to a daily chart and see what the situation is there as well. On a daily chart, we have indecision. We have a thin dot. So basically, if we want to be getting into trades, we want to be getting into trades that are to the downside on the weekly or either way on the daily. Now, we don't have to have trades that correlate with the market as a whole. If we have the market as a whole, which I'm going to use represented in pink, if the market as a whole is going up, then one of those 500 stocks, if that's also going up, then we've got correlation on our side. Because the market as a whole is bringing the market up, is bringing that individual market up, and those individual stocks are helping pushing the market up, they're correlated. It gives us extra probabilities. If the market as a whole is going up, but the individual stock we're looking at is going down, then they're not correlated, which means we have less probabilities on our side, because it may be that this market as a whole will end up pulling this back up again. And so where we thought we had probability downwards, actually it's upwards because of what the whole market is doing. So ideally we want to follow what's correlated. When we have a situation where we have a thin dot and it's not pushing one way or the other, then we can kind of look more into what do those individual stocks have to offer, where are they showing probability. What we'll start with, if we go to the weekly, what we'll start with is looking at the stock scanner that we have here, so that we can understand where we might have probability to the downside on a weekly chart. So we can take some short positions, because that would correlate with what the entire market is doing. So what I'm going to do here, I'll leave the max price. In fact, what I'll do here for max price, I'll put 500 and we'll do 15 for a minimum price. This is the stocks scanner that we're using here. I'm going to make sure that we look at stocks and ETFs, and I'm going to come to my additional filters. I'm going to come to auto climate, and I'm going to say what I want is the weekly chart to be confirmed down, sensible, and near the EMA. Why am I clicking these things? Because, for those of you that have no idea what I'm talking about, what this tells us, this is now going to show us a list of stocks where we have probability downwards, not too far overextended to the downside based on what usually happens, and close to an ideal trading price. That's what we're filtering for here. So let's click scan and see what we end up with. Now we've got a big list of stocks here that we can click through one by one. Let's now try and be a little bit more specific. I'm going to go to the earnings tab, and I'm going to say that I want to exclude earnings or stocks that have earnings within the next 5 days. Because if we're using a weekly chart, then we might be in, on our bigger time frame, we're using a 144-minute chart for our smaller time frame, then we might be in trades for a few days to a few weeks. So if we know that we are going to be taking trades that don't have earnings in the next 5 days, so the next 5 trading days, then we know we have at least a week for these trades to work in our favour, or maybe not, before we then reevaluate. So I'm going to scan for that as well. We now have a smaller list, still quite a long list. We could be even more specific and start being much more specific in terms of different things like stock filters, the rotation and the strength. We could say we want it to be early, so not even sensible, really early on that. Let's scan for that and see what we have. Again, slightly shorter list, but still a big list. So I tell you what, let's click through one by one, and we will see what we have. So we are looking for short opportunities because that's what would correlate with the entire market. Weekly chart on the left-hand side, 144-minute chart on the right-hand side. Now, what we're looking for here, and I can tell you very quickly that we don't have any opportunities at the moment on this one. What we're looking for is if we have probability to the downside, thick red dot there on the auto climate, what we would be looking for are red UFOs that look something like that. We'll see a real one in a minute, I'm sure. Red UFOs that also coincide with a similar price to the EMA that we have on the bigger time frame. What that's doing is combining sell orders pushing to the downside from the climate, sell orders that are coming from the UFO, which is not going there. There you go. Sell orders that are coming from the UFO, red UFOs, unfilled orders, show us where we have sellers. And then we'd also have sellers coming in from the EMA price. which in this case is going to be that line there. At the moment, we don't have those things coinciding, so we don't have a trade. No problem. So all we do is we'll come back to our matrix and we'll just click on the next one down. I am going to sort this by its symbol, actually, so that we don't end up, because if it's sorted by other things, then as we click top to bottom, it might move in its place on the list. So let's have a look here at ARIs. This is Apollo Commercial Financial Company, it looks like. So again, similar situation here. We don't have anything near a UFO on the right hand side, so we'll come back and we're just going to click through until we find a decent opportunity, which based on a list this size, I would be surprised if we didn't find one. So here we go, we found one now. There we go, brilliant, didn't take too long. So we have a thick red dot, probability to the downside. We know we're early in this, meaning the market would usually, if it goes down, go down for 3 weeks, and we're on candle number 1 to the downside. So that tells us that we have at least another couple of weeks, based on what usually happens, to see this market fall. Now, that's not to say, by the way, that that's definitely going to happen. It just means that it's more likely to happen because it's based on what usually happens. It's statistical. Give me a sec, guys. I'm about to sneeze, so I'm just going to turn my mic off for a second. Oh, sorry, I have a cold, so I'm sorry, my voice sounds a bit weird, and if I have to stop to sneeze occasionally. Okay, so we have probability to the downside with the climate. We're early in the climate. We also have red UFOs, so sell orders above us, showing us where sell orders are. We have a relatively decent probability rate, 49% probability, showing us that price 49% of the time moves between UFOs, regardless of where they are. So it doesn't mean 49% of the time is a bad number, because if UFOs are any more than 1 to 1 away from each other, basically, you're going to make money. If UFOs are 2 to 1 away, 3 to 1 away, 5 to 1 away, and they're being hit 49% of the time, that's a decent maths, the way that works out, decent ratio. So we've got a decent probability, we have sell orders, and they coincide with the EMA price. The EMA price is 25.91. It's very specific here on top, but 25.91 is about here, falling very snugly into this UFO. So that's the UFO we're going to use. Now, the data for top would be telling us that the final price there is 26.29. So 26.29 is going to be the stop loss, but we're also going to add 10 cents worth of wiggle room so that our stop loss goes 10 cents above this, gives us a little bit of wiggle room. So that'll be 26.39 is the stop. Our entry, we may as well coincide these two UFOs together because they're overlapping. So what we'll do is our entry is going to be 25.66. Our stop loss is going to be 26.39. Okay. So what I'm going to do, I'm going to come back to TradingView to place this. So we were looking at, what was the, just go back here for a sec. It is ATSG. So ATSG. Okay, great. And let's put the UFOs on. It's around about the same price, but we're going to use the top data anyway. It's slightly different data, but we're going to assume that you're connected to top, and that would be what the data that you would use. So the entry price, as we said, let's come back, is 25.66. In fact, what I'll do, I'm going to make a note here on a different screen so that I don't have to keep coming back and forth. So 25.66 is the entry, and the stop loss is 26.39. Brilliant. So let's come back here and put that on. So entry is 25.66. The stop loss is going to be 26.39. We are going to take profit initially 1 to 1 away. So meaning we are risking the same as what we would make. We call this our safety target, and we do this because we want to make sure that when we're trading, we want to make sure that we are not exposed to being a little bit right and then ending up losing money. If we're a little bit right and then it goes against us, we would rather make nothing, right? We would rather break even. So I'm just putting the visually here so we can see what our entry and stop loss is, and our safety target has been worked out for us by TradingView, and that's coming to 24.93. So our entry is 25.66 based on the UFOs we saw on top. Our stop loss is 26.39. Our profit target is 24.93, and we are going to risk $50 in total on this half of the trade. I do that just because it's a nice round number. It's half of 100. I make 100 the total trade risk. So you guys place whatever you want in terms of the amount of shares and the total risk. For me, I do it at $50 just to be nice and easy with the way I demonstrate. I'm going to place here on the text. So we placed this on the 24th of September on the live session. Okay, so that's that. Now, where is our second target going to be? We're going to come back to top to get the answer to this. Now, if you think about it, we are going to the short side. We're going to the downside, right? We've got sellers on top of sellers on top of sellers. So we are going to the downside. Now, if we're going to the downside, what's the only thing that can stop the price of something going down? It's buyers. The only thing that can stop sellers is buyers. So the closest stack of buyers that we have on the bigger time frame is here. And they start at 21.56. So that is going to be our just bringing up something here. That is going to be our final target. I'm just going to write it on a different page here so I don't forget. So 21.56, and I think we had, what was it, 24.93 was the safety target. So let's come back here and we'll do the same thing again. Entry is the same, 25.66. Stop loss is the same, 26.39. The profit target, I'm just going to type over here and put the price in, which is going to be 21.56, which actually coincides with the UFO on this one as well, and risk $50. And there we go. Start to finish, that is placing a trade. We used scans to look through thousands of stocks and come back and tell us where, which stocks had probabilities to the downside. We looked for probabilities to the downside because the entire stock market is to the downside on these time frames. So we've got correlation on our side as well. We looked for stocks that had probability downwards and that were early on in their move to the downside based on what normally happens or compared to what normally happens. So we lucked out on that one as well. And we also had an EMA value that coincided very nicely with our UFOs. So what that meant is that we had sellers plus sellers in the context of a selling environment. So it gives us more probability to the downside. If we're wrong, we have a stop loss to get us out. If we're right a little bit and we hit our safety target and then price goes against us, then we break even. If we're right a lot and price continues to go down and hits our final target, which I'll draw in now as well actually, just so we've got the visual, 21.56, then we would take the full profit from this. Okay, so that is one trade. So what we'll do is we'll cut the stream to the free sessions. We'll carry on inside the closed coaching community. So those of you that are within that, let me know in the chat box what stocks you might want me to look at or things like that. Happy to do that. For those of you that have joined on the free one, if I can just take you back to tradewithufos.com/Becky. If you don't have a free membership already, just get one, and then you can post questions here. You can email me by all means if you have questions. I'm happy to receive emails. But if you post the question here, it's great because it means that I can answer the questions in this same environment as well. So other people can see the questions and the answers. So it's good for everybody. So I will love you and leave you guys. For those of you that are joining on most of the channels here, have a great end to your trading week. Have a great weekend. I'll see you back on Monday morning for the market commentary. For those that are in the closed coaching, just stay with me. Bear with me for a second, just whilst I turn off the destinations to the other places, and then we'll continue. So give me a sec.